Hello, welcome to CryptoKeep's Trading Hub. My name is CryptoKeep. Yesterday, in my last video, I made mention about your entry price not being so important, but where you place your stop as the most important part of trading. So today, or right now, I'm going to tell you a bit more about those entries and why it doesn't really matter and why it also matters. Having a very perfect entry matters a lot, not as much as it matters for where you place your stop loss, but then it matters. The most important thing you want to focus on when taking a trade is where you place your stop loss. And the second most important thing is where you enter the trade. While the third most important thing, this is aside strategies, is where you exit. Or we have two exits, which is a stop loss or the take profit. We have the stop loss and the take profit. Those are the two entries. So these are the orders of what are most important when taking trades. Your stop loss is the most important part, where you place the stop loss, because that is what will determine how much you make from the market, which equates to how much reward you get to your risk. So if you have the perfect stop loss area or the perfect stop loss price from your entry, it determines how much reward you get from the market. And then your entry price doesn't really matter. Like I said in the last video, if price were to be here and you believe that the asset you want to buy when market structure is bullish, right? You believe it's going to come up to this extent. Nothing is stopping you from buying right here if that is where or where you spot the prices at that moment, in as much as you have the conviction that price will actually come there. So let's believe price is coming here, and you come on your chart or you see the price of the asset trading at this point. Nothing is stopping you from buying at that very point. Or if the price were to be here and you still believe price would come here, nothing is stopping you from buying at this point. Even if it were to be here, you can still buy in as much as you believe price will come to this very top. But then, because of how much you stand to make from the market, which is your reward to risk, because going into the market or buying this asset, you are actually exposing yourself to a certain amount of risk. That certain amount of risk is determined by yourself. If you want it to be 0.5% of your portfolio, which is your balance, your total balance, or 1% or 2% or even as high as 10%, which is not advisable. So if you are entering the market at this point, where would you place your stop loss in as much as you believe price will still come up to this point? So where will you place your stop loss? Let me quickly draw this market movement like this. So you have a movement like this, and assuming price was at this particular moment when you spotted it and you think it will still come here, where will you buy? Normally, some of us will wait for retracement. Like I said, there is something we call the fair value of an asset. Assuming price moved from this last low to this last high, you can take your Fibonacci to show you where the average of that price is, the average price. If that is your bargain price, where you think price is cheap, you can get in. If then seeing this former resistance, if you're a support and resistance trader, you believe it can turn to support, you can also get in there. And luckily, it might also confluence with the fair value or average of that range. If you trade supply and demand, you may believe that there is some demand came from this point, that price will get here and then it will continue to rally up. Also, if you're a breakup trader, assuming you may wait for price to then come down, come back up, close above this size before you get in. But then where would you place your stop loss? So stop placement is very, very important. So if you were to be a breakout trader, price comes down, so assuming this resistance now turns support, then it reverses, closes above of this old expensive price line. Now going above it means it's no longer it's no longer expensive, it's now being accepted as a regular price. If it closes above this, where will you place your stop? Will you place your stop somewhere here? Your entry is here. How much risk reward will you get between this point to this point? If you enter on this particular range, where will you place your stop loss? Will you place it here or below the swing? How much risk reward will you make from the movement from your entry to your target in relation to your entry to your stop loss? You should place stop loss using technical levels. Yes. So let's get into the chart and let me quickly take you through the cons and pros of having a sniper entry. Bear this in mind. I'm going to take it out now. So I don't want this video to be long. I spotted this BNB charts. CoinChef posted it on the group. He took a trade. I think it was right here. So this move, we just took a trade. So I saw it and I saw this movement. Now ignore everything to the left of this line. Ignore, oh sorry, that is not. Let me make it thick. Okay, ignore everything to the left, or the everything here, ignore it. So we are focusing on from this point to this point. Let me mark this again. I want to show, okay, from this point to this point. This middle part will be a point of focus. Now we have a low here and we have price going below that very lows. What does this mean? It means we are probably in a bearish market structure. If you take this size, this low, then this side, we have broken this low, which shows we are in a bearish market structure. If you trade support and resistance flip, how will you enter your trade? It means when price comes back to this old area of support, you want to enter the market, right? As a supply and demand trader, where will you enter the market? You'll be looking at this area of supply, right? And if you trade the Fibonacci, I don't know if this can get bigger. If you trade the Fibonacci range, like the fair value, like I said, the 50%, maybe 60%, where will you enter? Let's mark this. From this is the highest point to this low. So the 50% range is confluencing. No, I don't have 50% on this. But then it's almost confluencing the support turned resistance, right? So this is the cons of how you enter. Some people will enter right here on the breakout, while some people, let me open this maybe to get the shut down, so to squeeze a bit. Okay. Now, as by this trade, when it came back up, we saw that anybody trading support turn resistance, which is support and resistance flip, will be filled at this particular point. But you that is trading supply or demand, you are just waiting, you get no fill. You get no fill. That is a cons of waiting for massive risk to reward or reward to risk ratio. But this point, this is a pro for trading SR and a cons for trading supply and demand, because most times you miss out on good trades. So support and resistance trader who trades these flips will get an entry here and then boom, profit. Then look at the next trade that comes in line. We have the break of this low again by this week's. That means automatically you have an area of support and supply and demand at that particular point, and this point will be your support turn resistance. But what happened? Price came back into that zone, or if you were trading 50% range, it came back into the zone or into the area you might be short by at this point, but price kept going up. It kept going up to fuel the supply traders, and then when it fueled them, price came running down. So that is the pro and the cons. The cons is for supply and demand, you might not get your trades to be filled. And for support and resistance trade, how trade flips, you might be in some bits of drawdown. Now, this is it. This is another thing I want to mention. Now, let me use this. What's it called? Okay, this short and these two. Assuming as a support and resistance trader, you get your entry here. Where will you place your stop? I see as that. Some people believe maybe when this candle closes, they place their stop loss above this candle. If as a support and resistance trader, right, if you place your stop above this candle at this point, you'll be taken out in that area. You'll be taken out of the market. Let me remove this magnet. If you have your stop around this top here, you believe, especially maybe after seeing this candle move here that couldn't go up, you'll be taken out. So the best place to have your stop is above the highs of the swing. So if you are trading support and resistance, you have your entry at that point, you have your stop. Let's assume you have your stop at the top there, and price came to these very lows, you'll be making 1.2 R. That is 1.2 reward to risk ratio. Now let's see the reward to risk ratio a supply and demand trader will get. You have the same stop above the swing guys, and you have the same, I don't know if that is the same. Then you have the same profit taking price line. As you can see, this person will get more more reward to risk. This is a ratio of 2.27 compared to the ratio of 1.21 when that the supply, the support and resistance traders will get. So when you wait for more retracement for price to come deeper into a very good area of bargain, you get to have more reward to risk ratio, which means you make more money when you get a very, very perfect, or let me say, they call it sniper entry. Now look at when this market flipped. This market flipped at the point. Okay, we were going downwards here. We were going downwards, and then the market flipped. So where is the last high leading to the last lower low? I think it was here. Okay. So we got a flip, and then as a supply and demand trader, where will your entry be for this particular trade? It will be like these lows, right? You can even use this very one, but this is the last low making. But then support and resistance trader, we want to trade this old resistance turn support. Some even wait for confirmations. Now see, some of those traders who trade support and resistance flip will wait for confirmation. On this confirmation of this candle that it came down, touched the resistance zone, then another red candle. This is a very bullish Fibonacci candle. And for this to be as bullish as this with no tail to the bottom, it shows on the normal candlesticks that a bullish engulfing is happening. Now let me take it to the other candlesticks, the normal candlesticks, and we see what actually happened. Fine. This is a Fibonacci candle which had no tail, and the previous candle was quite a bullish engulfing candle, as you can see. So what do confirmation traders do? On close of this candle, or when the high gets broken by this candle, they enter the market. So they enter like this point here. They enter like on close, and then they place their stop loss below the low of that, believing that price made this engulfing candle because of price readiness to continue to the upside. But then see what happened. After the engulfing candle, price just decided to come back into this demand zone, and then it took off. That is for those who wait for confirmation for some support and resistance. Confirmation is quite good, but then it leads us back to the question again: where do you place your stop loss? So if you have your stop right here, you'll be taken out of the market, and this is a very good trade. But if you have your stop below the swing, you'll still be in this trade. Now let's see again with these two. If you are taking your entry, now Fibonacci is even giving us a lower price line. Let me take it back to the Fibonacci candles. Okay, so if you are trading support and resistance, this is long, you'll be getting your entry at that point, your stop loss will be at this point, and the price came up to this very highs, right? So at that particular highs, let me use this magnet tool to get it correctly. Okay, perfect. So as a risk, what's it called? Support and resistance trader who doesn't wait maybe for confirmation, you just take the trade. When it hits that old resistance line, place your stop below the last swing. You get to have a reward to risk ratio of 5.33, which means if you are risking $1 on this trade, you get to make $5. If you are risking $100, you get to make $500 and above. And if you are supply and demand trader and you are trading this point, you have your stop the same point as where the support and resistance trader is, and the same profit taking area. You get to have a profit profit of risk reward to risk keep missing this of 9.45. That means you are making 4 times more than the support and resistance trader will do, which is a good point when you get to have a sniper entry, which means you waited for price to come deeper into the swing and then you pulled the trigger, or you got a very, very good entry price. That is the difference. But then where you enter the trade, does it really matter? Some other people will enter when this new resistance now. We have a new resistance at this point, at this particular height. When it gets broken here, some people will get to take their trade on close, and then will they still have their stop loss below this last swing? But then this is no longer the last swing, right? This now is the last swing. So they have their stop loss below the last swing, and then they get the same profit taking point, or take profit price line as the other traders do. So they get 2.57 risk to reward. This is even worse than the person who took the support and resistance trader, who took when price came down and had the stop loss below the swing. If this trade were to have gone wrong, both the supply and demand trader, the support and resistance trader, the Fibonacci trader, who all had their stop loss below the swing, all of them will be taken out. But then if this breakout trader on breakout of this new swing, if he had his stop loss just below this candle that made the breakout, he still gets to take 4.44 reward to risk ratio, which is even still lesser than this first support and resistance trader, and way lesser than the supply and demand trader. But the con of trading this supply and demand is that sometimes your trade will not get filled, just the way price didn't come back to this zone at this point. Sorry. When you have your zone here, price didn't come back there, but the support and resistance trader got in. So what can you do to avoid this kind of missing trades? Can you just take your entries, maybe when you take 20-30% of your position size on the support, turn resistance, or resistance, turn support, and then you enter the remaining of your position size when it gets to the demand or supply zone? That is something you have to figure out yourself. But scaling in can be good, but sometimes if your demand zone doesn't get, as in price does not get to your demand zone, you still have some percentage in the trade and you can ride along with it. Now let me show you a sample of manipulation in the market. I think this will be the last talking point, and this has to do with break of structure. I will talk more about it when I'm doing something like advanced price action. I'm just starting for here. There's no particular reason for starting for this point. So we have a move low. Oh, is this it? Okay, this is it, I think. Okay, this is the structure we have. We have a structure here, higher high. This can be regarded as higher low, right? Then what happened at this point? Good, this is it. So we had like a move lower, but let's then ignore everything to the left of this. Let's ignore all this. So let's just start from here. So we have a move from a low to an high, another low, higher high, higher low, higher high. What is expected of us? We expect, or what do we expect of this market? We expect that price should in no condition go below these very lows. As a confirmation, this high was breached by this candle here. It made an higher high to this candle, as you can see. I don't know if you can see that, but now you should be able to see. This candle here made an higher high to this candle. It went above that, as you can see now. So I will take that out. So we have a low to an high, higher low, higher high, higher low, higher high. And we say whenever price go below the point of bargain, the lowest line price ever reached, cheapest price, that means something is happening, reversal is happening in the market. But then there is another catch. There is something I want you to notice. Then what happened? Price came below it, then we can see price then went again to make a very, very big move to the upside, creating another higher high. So what happened? Here is what we are missing. At this particular point of this last size, when this candle made this higher high, we did not see a close above of this high. That is one thing, and that is showing us that we are probably being stop hunted. There are people shorting at this particular point and their stops are being triggered, so they are being hunted. Then another thing to look at is this is the highest close, this is the highest close on this move before this down movement. This move up did not even close above this highest closing candle, which means if you take this to a line chart, I don't know if it will, oh, that is what I don't want to take me back. So if you take it to a line chart, it wouldn't show a close. Okay, I was using like an ashi. Sorry. I think this is a normal candlesticks. Aha, we have a close here. But then this close is just a single close. The next candle was a bearish engulfing candle, which showed clearly that this move up was clear stop hunt. No close above this, no close above it, and the highest close, which is that we had one close above it, then the next was a bearish engulfing candle, which shows that this move up breaking this size was not genuine, and so this still remained a last swing low. This particular low at this point still remain a last swing low, and this move up like this is just one big move. So I will take that out. So all this move is just one big move, and so when price came back, it still came into the area of demand, which was this an inside, but okay, no, that seems to be a morning star formation. So it came to this area of demand and then it rallied to the upside. So that is an example of manipulation. You will be seeing a a break of structure at this point, continuation of structure to the upside, but then it was basically a stop point. So if you have these particular lows as your last swing low to place your stop loss below this, maybe at this point, you will be taken out by this move. But if you endure the market enough to place your stop loss below this, then you will catch this massive move. So that is the essence of having sniper entries, and that is it about this video. I'm trying to remember something I wanted to show you again. Okay, but then I wanted that to be the last topic or last thing I'll talk about. So the last thing I think is I wanted to say was, if you are an Elliott wave trader, you can easily from this point of reversal count your 1 as this will be 2, This won't be 3 because of that hunting and being not a genuine move. This will be your 3. And if this were able to be your 3, it is quite lower than the first swing, which invalidates it. You always want your 3 to be 1 to 1 or more. So this will be your 3, this will be your 4, and then this will be your 5. And when you have 5 impulsive waves, you expect a kind of ABC correction, right? Or a deeper correction. But that is topic for another day. So this is the importance of entries and stop placements, and the importance and why your entries do matters. So entry price do matters, so you can get a very high reward to risk ratio. But entries do not really matter if you believe the price will still keep going up. The only thing that it will affect is your reward. You will make lesser money than when you get that perfect entry. Do not forget to subscribe, like, and share so I can know where to adjust and where to keep up the energy. Thank you for watching.